The 18.6-year economic cycle, what it means for land, stocks, and gold prices. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, welcome back Dhruv, who was writing earlier in the week about a very interesting longer-term cycle that appears to be consistently playing out in the markets and how we can potentially take advantage of that. How are you going today, Dhruv?
Good, Chris. Thanks for having me back.
Thank you for coming back. Now, really interesting article. You went quite in depth actually in this article today, talking about this 18.6-year cycle. Very specific numbers there. Do you want to start us off by just explaining what it is that you were talking about?
Absolutely. So if you really zoom out and look at the long-term economic cycles that are based on land value, the changes in land value that are generally based on the productivity of the land itself, they seem to form very predictable cycles that have roughly 18 and a half years from peak to peak, or you could measure them from trough to trough. Now, 18.5 or 18.6 is very much an average. These things, because they're on such a large time frame, can vary. The shortest cycle that's been recorded has been 17 years, with the longest being about 21 years. So they really just form these macro cycles that are beyond a point somewhat predictable in terms of booms, overvaluations, busts, and resets. I should mention as well, what happens with that is you see the rest of the economy being affected by these cycles. So you see assets like land being affected by it, but also gold, stocks, and other assets moving in conjunction with the cycle.
It's fascinating to me just how things that really shouldn't work in many ways consistently work over a long period of time like that. You highlighted a few really interesting points to me in the article where you talked about this phase two that we're currently in, potentially, if this cycle is playing out again, and no real reason to think that it's not. And you use the phrase, the winner's curse. I'd love for you to explain to us what that's about.
The winner's curse is essentially the final phase of the uptrend part of the cycle. So of 18 and a half years, we'll see an approximate 14 years up. In the final 2 years of this uptrend, before we get into the bust, just like most busts, it's preceded by a boom. In this boom, we see most assets moving up together. It's not just gold or just stocks. And it's basically everything moving up because of leverage or liquidity in the system rather than productivity. So that brings a lot more speculation, a lot more overvaluation, and that's just an unsustainable phase. The reason it's called the winner's curse is because everyone's a winner. Everyone's a genius. Everyone's a superstar. And they get arrogant and complacent. They start over-leveraging themselves. Risk management flies out the window. And essentially, when the correction or the bust happens, people aren't really positioned to weather that storm in a sensible way. A lot of people get wiped out altogether. So all that winning ends up becoming a curse because you might make a whole heap of profit in the final 2 years, but you end up losing it all in the subsequent bust because of your greed and complacency, I suppose.
And how many people experience that in the Bitcoin or crypto booms and busts? We've probably seen that. That certainly hasn't taken place over that long period, 18 plus years, but we've seen it sort of in fast forward where people make a lot of money in that blow off top scenario. They feel like they're a genius. It's so easy. I can make this money. So they double down, they triple down, end up losing it all. We've seen it happen so many times over and over again.
Spot on. The same human emotional experience will take place over various time frames. So the 18.6 years is just the largest time frame that I've sort of seen it play out over.
Yep.
But you'll see it play out within a 4-year cycle. Multiple 4-year cycles will make a 20-year or roughly 18 and a half year cycle. And you'd actually see multiple 20-year cycles make up a 100-year cycle, which gets into the theory of the various turnings, the first, second, third, and fourth turning, which is a much longer and separate conversation. But, that sort of brings us back to what happened around the Great Depression era and looking at multiple 20-year cycles resonating with one another and building on one another.
So you highlight these three phases that occur in the cycle. Can you maybe take us down the path now a little bit on what specifically happens with land, stocks, gold? I mean, obviously a lot of us will be interested in how gold performs across those phases. Can you just sort of step us through the asset classes and how they unfold as it goes on?
Absolutely. So just to distinguish between the three phases, phase one and phase two are the uptrend, essentially split down the middle. So there's the first and second half of the uptrend, with phase three being the bust or the collapse phase. Now, the first phase is about recovery from the previous collapse. It's about economic productivity. And so you see assets like land and stocks moving up together purely based on a healthy economy, based on the land becoming more productive, based on increased liquidity in the system as well. But you see stocks based on the company's productivity, price to earnings ratios make sense, the amount of debt on the land makes sense. The US dollar tends to gain strength in this phase as well, simply because it's the world's largest economy, and if there's an economic recovery, it's going to lead the way. Gold in this phase goes into a healthy accumulation phase, where it's just experienced a massive boom in the previous two phases, and people are now reaccumulating gold for the next phase. So that phase one was much earlier in the decade, sort of post GFC 2009 onwards. We've been through all of that already. Phase two is the second half of the uptrend. Now it's divided by a mid-cycle slowdown. So we've experienced the recent bear market in 2022. So the chop around, the post-COVID era is the mid-cycle slowdown, and a lot of recession fears come into the market between phase one and phase two. So we've all seen that. All everyone's talking about is a recession coming, and people don't understand why are asset prices moving up when there are so many cracks in the system and everything should be collapsing. But what that is that's pretty typical of phase two, where there's a lot of recession fears in the mass consciousness, but asset prices will continue moving up because liquidity is now entering the system in a big way. There's a lot of leverage. Land prices are going up because there's more debt on the land. There's more credit created by banks, central banks, and private banks as well. You see a lot more speculation on assets, and the price to earnings ratios get blown way out of whack. So you see assets increasing value, not so much because of productivity, still productivity, but now it's mainly driven by liquidity and leverage. What that means for the US dollar is it starts losing value in a big way, because increased liquidity, increased supply for the currency means reduced value, and you see the US dollar start to fall off a cliff. This phase two, is where you start seeing a really sustained uptrend in gold and silver. Now, we've seen that already start to take place, over the last 2-3 years, and really start to take hold. People are starting to notice these assets a lot more in the mainstream sense. A lot more people that would not normally be talking about precious metals have suddenly found it to be somewhat interesting. And it's starting to gain a lot of momentum to the upside. So all through phase two, right into the winner's curse phase, we'll see precious metals like gold and silver do exceptionally well and continue up while the US dollar goes down. As you get into the next phase, post the winner's curse, when everything starts to collapse and fall apart, you'll see assets like stocks just take a massive beating. You'll start to see systemic failures take place in very important financial institutions. Like you might see mass banking collapses across the board. You'll start to see systemic failures. At this time, you'll see land prices fall off a cliff. You'll see the stock prices fall off a cliff. And people are looking for a safe haven asset. So what you see is gold and silver will continue moving up into phase three, into the collapse, while other asset classes start to struggle. So while we're in phase two and there's increased liquidity, and while everyone's a genius, everything's moving up together. But there does come a point when the highly speculative assets that are over leveraged, like land and stocks, are unsustainable and fall off a cliff. And the assets that are sustainably growing based on their intrinsic value, like gold and silver, will continue moving up through the collapse. So what you should see in phase three is the dollar has already fallen off a cliff and starts to accumulate sideways. Stocks and land fall off a cliff and have a huge beating. Massive amounts of leverage is cleared out of the system. But gold and silver continue up to the end of the cycle until all of the other assets have bottomed. And then the cycle repeats again, with gold and silver moving back into healthy accumulation, getting ready for their next leg up.
So that sounds very promising for gold and silver, because they serve that role in phase three, which is really the scary one, that is in the future for us at the moment, but is something that we can be looking at. And as you've said, gold and silver do very well in phase two anyway, when everything's going up. And that makes a lot of sense to me. obviously we're living in very unusual times, and to make the argument that this cycle continues, I mean, it's very dangerous to move against things that have worked over a very long period of time and not expect them to happen again. But there could be arguments made about things like AI, things like just the sheer level of debt that now exists in the system, other factors that could potentially see this time as different, or we're heading into a future that is very different to what it has been in the past. Do you think that like there are some other things that we need to be looking at or thinking about, or probably if I was to phrase it a different way to wrap this up, how as an individual institutional person who's interested in following this along and can see some of this coming, would you play it? Do you go fully in on the assumption that history repeats? Do you sort of go half in on the assumption that this time might be different? How do you think about that?
Yeah, it's a really good point because, like you said, we are in seemingly unprecedented times, and I don't think history ever repeats exactly, but it almost always rhymes in these cycles. And this data is based on about 250 years of American land data and about 350 years of UK land data. And I'm sure each cycle felt very different and unprecedented when you're in it to previous times. There's been a lot of technological change over these 250 to 350 years, from the Industrial Revolution to all sorts of things that have happened in the way we live and interact and move money around the world, and the financial systems that have existed during these times. Now, if you look at how to prepare for this time in terms of it being, slightly different, or just not necessarily blindly going by the books, I'd say the only thing that has been different from cycle to cycle is the exact timing of it. Because sometimes you say 14 years up, 4 years down, 18.6 years. People start using these numbers as gospel. These are rough figures, and some cycles can be extended, some can be a lot shorter. So I think figuring out where we are in the cycle is pretty important. And in terms of how to play it, I would basically look at, once you know where we are in the cycle, looking at which asset classes make the most sense and managing your risk accordingly. There are certain finer aspects that might be different this time around. There might be new asset classes that emerge that have not existed before, like Bitcoin, in terms of finding shelter from that storm. But looking at something that's existed for 15 years, over 350 years of data, it is yet to prove itself to see exactly how it plays out during those times.
Of course, yeah. And I think I really would hope that with a little bit of this information behind us, we can hopefully avoid that winner's curse that you talk about, where we think we're geniuses right into the top. That seems to be the real angle that we all need to be paying attention to, regardless of what happens, really.
What's interesting about the winner's curse phase is most people avoid the early leg of phase two, where the markets are recovering from that mid-cycle slowdown. And because this recession fear is so prevalent among the, everyone's conversations, that they think they need to stay away. But when you see markets moving up for 4 years in a row, and then exponentially so, it's really hard to stay out of the markets. And that's when everyone's like, yeah, recession's not happening, just in time for most people to be in the markets. And that's when it collapses. So the idea of avoiding the winner's curse phase is essentially to, again, not get caught up in emotions like we've spoken about before, and try to stay risk averse to an extent as well, and not make financial decisions based on more of a, greed-based mindset.
Look, an absolutely fascinating discussion. I think people will get a lot of value out of this. I certainly will be going back and poring over those dates a little bit more closely, even though we're not saying those are exact dates. But it's very, very interesting to see something that has stood the test of time so well. And when you explain where that data comes from and what we've seen over and over again, really, you have to at least have that in the back of your mind. You really can't ignore it. So thank you so much for your work on that today, Drew.
Thanks so much, Chris. Thanks for having me on.
Thanks, everyone, for watching. We'll chat again soon.